Hi everyone, and welcome to the Finance for Life podcast, a show that is designed to demystify the finance world and help you make informed decisions when it comes to mortgages. I'm your host, John O'Malley, and today I am joined with my colleague, Steph English.
Hello.
Hi Steph, how you doing? We are here today to dive in a little bit deeper and just demystify the world of mortgages just a little bit more for everyone out there. So, first things first, Steph, how are you?
I'm not too bad.
Yeah.
Not too bad.
And you had a good day today?
Yeah, a wee bit deja vu, but...
It is a bit of deja vu today because this is the second time we've done this. Yeah. Yes, we got the first one wrong, but we're getting there. Thank you, Steph, for coming along and putting down your pen because I know you've been busy today.
Yes.
And thank you for helping me do this as well. So, Steph, why don't we just start out with just asking a simple question? What is a mortgage?
It is just a really fun contract to enter into. No, but basically what a mortgage is, it's just a loan. It's just the name that's given to a specific type of loan for purchasing property. So in its simplest term, someone will lend you money, not necessarily an individual, but a lender, for example, not necessarily a bank, but a building society. Mm-hmm. A finance company will lend you the money. You will pay that money back. And they will charge you interest, which is just an extra payment on top, essentially for the pleasure of borrowing that money, and that's how they make money.
So it's just a big, massive car loan, basically, but for a house.
Yes.
Yeah,
a lot more regulations in place, that sort of thing.
Yeah, a
lot more to lose, but essentially, yeah.
But yeah. Okay, well, that is a very concise explanation, Steph, and it is, and it's good. So why don't you tell me a little bit about how maybe mortgages differ from Scotland than other places in the UK, like England and Wales?
So in terms of like a mortgage contract itself, north and south of the border, there's no difference. Mm-hmm. There's difference in the processes of applying for the mortgage. The home report, for example, is something we've got in Scotland where it's essentially just a survey on the home. And England, for example, will do the surveys after the offers have been accepted and the mortgage application started. So there's differences in the process. Mm. In terms of the actual contract itself, if you're north or south of the border and you go to Halifax, for example, it will be the exact same mortgage.
Right. So it doesn't really matter where you are in the UK in terms of actually gaining the mortgage part of buying a house, but obviously the process in buying a house is fairly different.
Yeah, the loan itself is the same, but if you've got government schemes, for example, again, they'll differ depending on your devolved nation, but in essence, the contract is the same.
Okay, so if we do have any listeners listening in England, please feel free to give us a call because we can handle your mortgage as well.
Just travel down,
get the train. Yeah, we'll stop in somewhere, that'll be fine. So thank you again for that. So why don't you tell us then, obviously, because what I do find with a lot of clients is they come in and they don't have a real great understanding of a mortgage, but if I asked them to explain things like a car loan to me, they'd probably be able to explain it.
Yeah.
So when I think about a mortgage, I think to myself, well, it's not all that different. What makes it different is regulation. It's obviously a bigger commitment for a longer period. And obviously because it's such a long period, we can't hold people in the same rates and same things like that for that long a period. So what we get is we get different products to use within the mortgage market. So why don't you tell me a little bit about the different products that are available specifically in Scotland as well?
Yeah. So as you say, there's a couple of different options depending on what it is that you want to do and what you're looking to achieve from your mortgage. Again, if you are buying your residential home for you and your family, that's going to be different than if it's like a buy-to-let property that you're trying to make money from. Yeah. So depending on what route you want to go down, there can be a few options there. Okay. But basically what every lender has is a standard variable rate. Now, depending on who you use, they might call it something slightly different, but essentially they're all standard variable rates. And it's their rate to do whatever they want with. They can put it up, they can drop it down, they can change it at a moment's notice. Right. It's the most volatile rate they offer, and it's typically the most expensive rate that they offer as well. Right. Good thing is they offer discounts from that, and they tend to be split into two groups. So you've got a fixed rate, which does what it says in the tin, it's fixed for a certain period of time.
And just to clarify on that, the certain period of time usually is 2, 3, 5 or 10 years.
Can be, yeah. So sometimes you'll occasionally get one that's maybe a 1-year fixed rate. You do get ones that are longer than a 10-year fixed rate as well. There's a couple of new providers out there that are doing like a fixed for life. So it'll just be fixed for like 35, 40 years sometimes.
That's not too bad, yeah.
It depends what you're looking to do. So yeah, it's fixed for a certain period of time depending on your circumstances, and it doesn't matter what happens during that period of time, your interest rate will not change. No matter how many governments would go through.
That's it, and that is a good thing. It is a good thing because it gives you a fixed cost and it helps you budget. It does help people budget. They know what their mortgage is every month. But when it gets to the end of that product, that fixed term, for instance, what happens? Because the mortgage is for 25 years plus. But the fixed rate might only be for 2 or 5 years. So.
And that's the thing, whatever you want to happen will happen. So with your fixed rate, as you say, the good side of it is you've got that stability, you've got security in your budget. But on the flip side, the negative to that is if interest rates fall, you're still going to be fixed in at that higher level. The good thing is you get to review it every couple of years, as you were saying. So if you were to fix in for 5 years, for example, in about 4.5 years' time, your lender will send you a letter to let you know that your interest rate's coming to an end. If you've got a decent broker, they will phone you and let you know your interest rate is coming to an end. But it depends what you want to do at that point. If you want to fix into another rate, you can do that. You can stay with your same provider. You can go to a different provider. If you want to go into a variable rate at that point, you can do that as well. It's whatever it is you want to do, you can. You've got a lot more flexibility now than you did before. If you want to borrow more money and put an extension on, you can. If you've came into some money and you want to pay more off, you can do that as well. We can change everything when your rate's due for renewal.
Well, that's good. I mean, and the main the main headline I would take out of that is really that when you do come towards the end of your term, your broker should be contacting you.
They should be.
Because if they don't and you do nothing, you're going to go on to that standard variable rate.
Yes.
And the standard variable rate right now, guys, we are looking at rates of 9% plus.
Yeah, there's a couple in there that are a little bit less, and depending on what Bank of England do, they might come down a little bit more, but they're always significantly higher than your kind of standard rates, if you like.
So it basically could mean your payments could double, and you don't want to be caught where it's the month of November or a month before a birthday or something like that, and all of a sudden your mortgage goes from 600 to 1200 and you've not done anything about it. So a really good broker, Kaluna, will give you a call and we'll be able to fix that in. And we can fix that in sort of roughly about 3 months before.
About 3 months before, yeah.
It used to be 6, isn't it?
It depends what's happening in the world at the time. They can extend it. There's still a couple of lenders that will do 6 months, but the majority of them will do 3 months before.
We'll do 3 months.
And you don't want to wait until the month before, because at that point you risk running onto the variable rate.
Yeah, so really if your mortgage is going to come in an end, I would probably say give us a call, maybe about month 6 or month 5 at the very latest. And what we can do is we can start to review the products, look at what's there, look at your current situation, and then when month 3 comes along, we can really start to lock in that new rate for you and ensure that you're not going to pay a higher amount or any more than you have to. I think that would probably be.
But that's it. I mean, the extra money you're paying, it's not coming off the debt. You're not reducing that loan any quicker. You're purely just paying extra interest at that point, which is lining the lender's pockets.
And another comment I do hear from a lot of people when they're getting the mortgage is they see this, they're borrowing, let's say, X, and it said the full repayment amount is Y.
Yeah.
And again, this is really just relating this back to the fixed rate versus the actual term, the mortgage term itself. So don't ever pay attention to that, because usually I'll see people borrowing 100 grand and they have to pay back 200, but obviously if you change your product every 3 to 5 years, whenever your fixed rate is up, you'll probably see that amount, you won't actually pay anywhere near that amount. Is that right?
Yeah, it's a horrible, scary figure.
It is.
But like say you take a 40-year mortgage, for example, on a 5-year fixed rate, that's looking at 5 years on a fixed rate and then 35 on this standard variable rate that's much higher. Realistically, that won't happen. So it's a huge number. It's a sobering number when you sit and read it in your appointments. It is. So you will always get that read to you when you're in your appointment with your mortgage advisor, or you should anyway. But don't worry too much about that, because it's not really a true reflection of what you're going to pay. Yes.
Yeah. Okay.
But that's your fixed rates. You've also got your variable rates.
So
your variable rates are linked to things like the Bank of England base rate, and they'll essentially track an interest rate of sorts. So they'll track something. So they can go up and down every couple of months depending on what's happening in the wider world. Now usually your variable rates will only last for 2 years, and then you would review it again at that point, because they can be just a little bit more volatile. So if you've got a lot of excess money in your monthly budget and you can withstand your monthly payments going up a bit, then it might be something for you. But otherwise, a fixed rate might suit you better if you're wanting that security.
And just for our listeners out there, because I know there used to be a lot of products out there on the market where it was interest only. There's not so much anymore.
Not for residential.
Not for residential.
Yeah.
But tell me about the interest only and just how it works and why it's maybe not there anymore.
Yeah, so in years gone by, what you would do is you would buy your house. They were obviously significantly cheaper than they are now.
Yeah.
But you would buy your house and you would take out a mortgage on an interest-only basis. So say your mortgage amount was 20 grand. You would only pay the interest on that every month. You wouldn't actually reduce the debt at all.
So it was actually a much smaller payment month on month.
Your monthly payment would be absolutely fantastic.
Yeah.
You're fine there. But the contract that you had to take out with it would be an endowment policy. So you had to pay that up every month. And in theory, what was meant to happen is the endowment was meant to be larger than the mortgage balance, and you would use that endowment to pay the mortgage off.
At the end of its term.
At the end of the term. Hit a few financial snags along the way. The endowments didn't cover the mortgage balance anymore, so there was a lot of people that were getting to the end of their mortgage term, so they'd be later on in life and they just wouldn't have the money to pay this loan off, essentially, and they lost their homes.
And it's such a shame as well, because these people have done this based on the advice given at the time.
That was it.
And obviously that advice hasn't worked out for whatever reason.
Yeah.
It's obviously, but what I would advise, I think now, and really the mortgage market, is probably stay away from interest only on a residential purchase.
For residential, there are very limited lenders that will do it in circumstances that would work. You're going to need to have a significant amount of equity in the property, or you're going to need to have something like an ISA, something where the money's secure that you can use to pay off the rest of the loan. They're not going to allow you to do it just based on the sale of the property.
Yeah. And just touching on other products that are available on the market, there's not masses amounts of them, but we've got things like cap and collar.
Yes.
Yeah.
So your capped and collared rates work on a variable rate. Essentially what you'd have is a cap, which is kind of like the top, so as in like a cap on your head, that's as high as interest rate would go, and then a collar, as in the collar of your shirt, is the lowest it would go. So even though your monthly payments could change, there would be a set limitation.
So you would know what your max budget would be, what you were going to pay, and you would know what the lowest amount you were going to pay. Yeah. And obviously that tracks the Bank of England base rate. Can be a way to reduce the amount of interest you pay, would you say?
Possibly, depending on the circumstances, but it depends if interest rates are going up or coming down.
Yeah, that's it. But still, I think we'll start to see more of these products on the market in the coming years. I've been speaking to a few different financial advisors, and they feel that there could be...
How dare you?
I know, I'm sorry. They feel there could be more of these types of products landing around. But
don't get me wrong, there are a few. So there's like an offset mortgage, for example, where you would need to hold money in a bank account with your lender, and they would offset the savings that you've got against the mortgage balance. You won't get interest paid on the savings, but it reduces the interest that you'd pay on the mortgage balance.
Right.
So there's ways of doing things like that, but again, it's just going to depend on your personal circumstances, your savings, that sort of thing.
Yeah, definitely. Okay, so what factors should potential home buyers consider when applying for a mortgage?
As in their personal circumstances, that sort of thing.
Yeah.
So again, everything. A mortgage lender, your broker should be looking at every aspect of your life. So you've got your savings that you've got at the moment. Maybe not the best idea to put every single penny into your new home. You need an emergency fund. Something always happens, something comes up. You need to have something to fall back on.
Yeah.
They'll look at your commitments. So any loans, hire purchase, PCP, student loans, even things like Klarna will all be taken into account. If you've got a significant other birthday coming up and you put everything on Klarna in a month, you're going to look like you're desperate for credit, and that can result in your application being declined at that point, and you'll need to wait a number of months until that kind of sorts itself.
And usually what would you say in terms of applying for any other credit?
Just don't do it.
Just don't do it.
Just don't do it. I mean, things happen. Sometimes you need to buy a new car. You need a new washing machine because yours is broke down. Circumstances come up, but don't make any significant purchases that are going to rely on a credit application in the months leading up to a mortgage. Once you've had your mortgage appointment and your application's going through, don't jump the gun. Don't get too excited and go and buy a new couch and everything and put it on finance, because it could result in your mortgage application getting declined.
You don't want to be sitting with a couch with nowhere to put it.
Nowhere to put it,
You
no.
know, so no. Definitely. Okay, now what would your recommendations be for a person thinking about getting a mortgage, maybe even thinking about, let's say they're a first time buyer, what would your recommendations be to them at maybe they were thinking about getting a mortgage or a property in the next few months?
Book an appointment with a broker. Speak to someone first about what it is that you want to do and what you want to achieve. I know it can be really tempting to just go online on Zoopla, Rightmove, find a house, go and view it. But until you've had a wee look at your finances, you don't really know what the situation is. There's been a lot of people that have thought they could maybe borrow X amount. They've came in, we've had a wee look at the credit reports, and there's things that they didn't realise was on there. Things from years ago, an ex-partner, that sort of thing, and it's reduced their ability to borrow. So if you check all that up front and you're really confident in your figures, you know how much your monthly payments are going to be, your utility bills, your food shop, you can go in and you can view somewhere with the confidence that you can afford that every month and that you can make that offer and be in a really strong position.
Yeah, and I think that's probably the best advice you could give, to be honest with you, because the way I see it, I always see the same thing. People go property first. You know,
that's the exciting bit though.
That's it. They go for the exciting bit.
Yeah.
The money part is the boring part.
Yeah.
But it's the whole key to the process, you know, because if you've not got the money, you're never going to get the property. So really, you need to make sure that you speak to a broker first. You need to make sure that you get all the bits and bobs done in terms of paperwork and looking at your credit file, reviewing how much you can afford, reviewing how much you can spend every month before you really start looking at property. Because what you'll find is once you've got all that information down and you know exactly what you can spend and afford, you'll actually have more fun looking for a property, because you'll be able to know that you can get this property. You'll be able to know that this is within your budget. You won't go to a property, fall in love with it, get to the mortgage section and realise you can't afford it. And I see that so many times, and it puts so much disappointment as well, you know, it creates so much disappointment. So I do think that Steph's advice is probably the best advice you could possibly give. Get the numbers done first, take it from there. Yeah,
and I mean, again, a broker should be chatting you through the full process. Buying a house isn't free. You're going to have legal fees. There's potentially, again, it's south of the border, you're going to have searches, surveys and things that come up. You want to know what you're getting yourself into before you get through that door, and you do fall in love with it, and then you try to make everything work from there. Again, especially in Scotland, when we do still have things like closing dates and there's a number of interested buyers, you make sure that you're the best and you're in the strongest position so that you can win that property.
Yeah, exactly, 100%. Okay, well, thank you very much, Steph. Again, have you got any final words of wisdom that you would like to give our viewers?
Just book an appointment, get in touch. Even if you are thinking of buying in 12 months' time and you want to have a quick look at your finances just now and see things that you can improve on, book that in. We can run through it, we can take a kind of quick glance and see where we are and what we need to kind of change to put us in a more favourable position for lenders and for sellers.
Yeah, thanks very much. Thank you. So this has been our podcast series, Demystifying the World of Mortgages. Next episode, we will be looking at fees that are included with mortgages, fees with buying a property in general. We will look at everything, we will break it all down for you and make sure you're fully aware of what it's going to cost you to basically get a mortgage and buy a property, because it's not just as simple as looking at a property at £100,000 and that's what you've got to pay. But again, we will break all that down for you, we'll give you all the information, and we hope this information is really coming across in a way that is easy to understand. Now, what I would ask all our viewers and listeners to do is comment on our podcast and tell us if there's any questions you've got, any concerns you've got, and even don't hesitate to pick up the phone to us. We're always on the end of the phone and always available to talk, just if it's just for advice only. So don't hesitate to give us a call. Steph or myself is always happy to help.
Yep.
And if you've got time, please subscribe to our channel that you're watching on so you can catch our next podcast. And we're going to be going through a full series of this, just making sure that we break down everything for you. And again, any questions that anybody's got, pop them in and we'll be able to answer them in these podcasts. But guys, thank you very much. Steph.
Thank you.
Thank you. And have a great day, guys. Thank you.